Market corrections do not announce themselves. They never do. They don't ring a bell. They arrive in complete silence. One quarter, your portfolio looks exactly the way it always has. Your positions are intact, the dividends arrive on schedule, and the yield percentages hold steady in ranges that make your income plan feel mathematically secure. The very next quarter, the screens show numbers that completely break that plan. The question that dictates your next move isn't whether the stock price will eventually recover. The only question that matters is whether the dividend itself is going to survive long enough for a price recovery to matter. Permanent structural damage to an income stream is the correction's true impact, far outlasting the temporary discomfort of a falling share price. Most monthly dividend positions completely failed to survive the 2026 correction without cutting their payouts. A dividend cut registers as a sequence of quiet, scheduled disappointments. You check your account on the date you expect your income and find less than expected, or nothing at all. A betrayal of the specific life plan you built your reinvestment cycle around. Yet during that exact same period, exactly 5 monthly payers defied the market and did not cut their dividends. Specific, identifiable balance sheet characteristics, established long before the disaster hit, made these 5 companies structurally capable of maintaining payments while the rest of the market failed. The first shared characteristic is a free cash flow coverage ratio that remains above 1.2 times throughout the entire correction period, and critically, at the absolute bottom. A 1.35 starting ratio becomes a liability when revenue compresses toward 1.0, funding the payment only if nothing goes wrong. A 1.7 ratio provides a safe floor, plateauing at 1.4 to maintain a wide margin. A high pre-correction coverage ratio transforms the act of maintaining the dividend from a desperate financial stress test into a routine capital allocation decision. The second characteristic is debt maturity positioning that explicitly avoids the refinancing cliff. Over-leveraged operators in 2026 faced a simultaneous collapse in demand and a requirement to roll over cheap 2021 debt into a high-rate environment. This creates a mathematical trap. As revenue shrinks, the spike in interest expense expands upwards, squeezing the cash available for distributions at the exact moment the coverage ratio needs the most headroom. The 5 survivors avoided this cliff by maintaining fixed-rate debt maturing well beyond the correction period, or by carrying significantly lower leverage than the sector average. The combination of revenue pressure and the sudden arrival of refinancing costs is what ultimately destroyed payouts across the market. The third characteristic is revenue source diversity that prevents any single economic pressure point from destroying total cash flow. Long-term triple-net leases with essential service tenants provide a contractual immunity that prevents revenue from evaporating, a stark contrast to the cyclical income generated by short-term loans. Survival depends on the specific character of the revenue source and its ability to decouple from the exact conditions driving the market crash. Survivor 1, a business development company, used its 1.68 starting coverage to absorb credit stress in its portfolio without ever needing to touch the distribution. The second survivor, an essential retail REIT, passed operational cost pressures to grocery and pharmacy tenants through triple-net leases, allowing contracted rent to escalate on schedule. Survivor 3 was a utility MLP. While the energy sector struggled with price volatility, this company's pipeline capacity contracts paid based on volume, insulating its income from the broader commodity crash. The fourth survivor, a healthcare REIT, generated contractually obligated rent from medical facilities driven by demographic need, disconnecting its revenue from the economic cycle. The fifth, an industrial REIT, held long-term leases with logistics tenants who actually required more facility capacity to manage the supply chain complexity created by the disruption. These 5 distinct companies shared the same pre-existing defenses, sufficient coverage, secure debt, and demand-proof revenue that completely decoupled their income from market conditions. These structural defenses were identifiable long before the first signs of the correction appeared. Investors who identified these traits continued receiving their monthly deposits unchanged, while others were left reading press releases about dividend cuts. The 2026 correction is over, but the next one is mathematically inevitable. The question is whether your current positions share these survival characteristics, or if your income will collapse under the next structural stress test.